Some hedge fund managers make more than $1 billion a year, while managing more money than the entire GDP of some European nations. They're also constantly in the media for illegal scandals, insider trading, market manipulation, and of course, Ponzi schemes. And even our good friend Jeffrey Epstein supposedly had one. Hedge funds are some of the most powerful financial institutions on the planet. They control trillions of dollars, influence asset prices with their trades, and shape global finance in ways most people don't even realize. So what actually are hedge funds? How do they work? How do you join one? And how do they manage to make money even when they lose? Let's go. In a sentence, a hedge fund takes money from rich people and institutions and invests it in a wide array of assets. Pretty simple. Except these guys are meant to be the market wizards. Unlike traditional funds, these guys are pretty much expected to make money and maximize their returns in any market condition. Markets on a tear, they better be beating it. Markets shitting the bed, they better have predicted it and set themselves up to make money in advance. In fact, the number one unwritten rule of hedge funds is never lose money. Now, there's also some other key characteristics that make hedge funds special. One, they're only for the wealthy. Unlike mutual funds, hedge funds are not open to the public. In fact, they can only take on accredited investors, which typically means having a net worth of at least $1 million or an income of $200,000 a year. Two, they're lightly regulated and far more secretive. They're the cowboys of finance. They operate under far fewer rules compared to traditional investment funds, and they don't have to disclose their trades until they file their 13F reports once a quarter. Three, aggressive and high-risk strategy. Unlike mutual funds that mainly buy stocks and bonds, hedge funds are able to use short selling, leverage, derivatives, and algorithmic trading to help maximize profits. A few quick definitions because these are important to understand. To understand short selling, I'm going to use a simplified example. Let's say you think Apple stock is going to go down in the future, so you call your broker and ask to go short one share of Apple stock. They take a share of Apple from someone else's portfolio, sell it, give you the cash. Now you have $100 cash, but you owe your broker one share of Apple. Tomorrow, Apple stock tanks and goes down to $80. You now decide to cover your short, buying back the share of Apple at the new market price of $80 and return it to your broker. Congrats, you've made a profit of $20. Leverage is simply using debt to make your positions even larger and therefore your trades even more profitable. Now, if your trade goes wrong, you'll obviously lose even more money than you actually have. I like Buffett and Munger's attitude towards leverage. If you're smart, you don't need it. And if you're dumb, you shouldn't use it. Derivatives are financial products whose value is based on an underlying asset. You might have heard of these before. The common ones include futures, options, forwards, and swaps. 4. Fees. Because of their promise to never lose money and make outlandish returns, their typical fee structure of a hedge fund is known as 2 and 20, as in a 2% management fee and 20% of profits. And this is how hedge funds always make money even when they lose. They take 2% whether or not they made a single profitable trade that year. Take Citadel, for example. They manage around $65 billion in capital. The 2% fee they charge brings them in $1.3 billion